Hello, everyone, and thank you for joining us for the cryptocurrencies panel at the 2020 FinTech Junction Conference. My name is Odelia Tortman, and I cover FinTech and digital transformation for the IFC, the International Finance Corporation, a member of the World Bank Group and the largest global development institution focusing on investment within the private sector in emerging markets. Now, today we're going to discuss one of the hottest topics of the year, cryptocurrencies. 2020 was an extremely challenging year globally and economically, yet an amazing phenomenal year for digital cash and cryptocurrencies. The crisis has highlighted more than ever before the need to upgrade existing payment infrastructure. It has decreased the usage of cash. It has introduced new partnership models between different traditional payment players and different new crypto/blockchain-based applications. It has reframed the discussion of Bitcoin as a store of value and as a medium of exchange, and it has accelerated even further before the race towards the central bank digital currency and the digitization of assets. And in order to discuss all of these and others, I have with me on our virtual Zoom stage a group of amazing industry experts and friends, which are now unable to introduce themselves. So gentlemen, please. Tomer, why don't you start?
Thanks, Adelia. Hi, everyone. I'm very happy to be here. My name is Tomer Michaeli. I'm a general partner at Viola FinTech. We are a $120 million FinTech-focused fund based out of Israel, but investing globally. We are a part of actually a much larger group, the Viola Group, which is the largest tech-focused investment group out of Israel, which manages $3 billion in assets under management. The group invested in many of the the best fintech companies that came out of Israel, like Actimize, Payoneer, Pagaya, Personetics, to name a few. My fund specifically is backed mostly by financial institutions, global banks like BNP and Scotiabank, and prominent insurance companies like the Travelers Group. So we are deeply embedded within the financial industry ecosystem. As for myself, I'm coming from technology entrepreneurship background. Most recently, before starting the fund, I was a fintech entrepreneur who started a fintech company called Fundbox, which provided short-term credit to SMEs in the United States. So I sort of like been both sides of the table, both as an investor as well as a founder. And again, great to be here, and thanks to Delia for having me here.
Thank you, Tomer. Great having you here. Ofer, please.
Hi, thank you, Delia. It's a pleasure to be here. My name is Ofer Rotem, and I'm a founding partner at Collider Ventures. I've been an angel investor in the blockchain space since 2013. That year, I first heard about Bitcoin, and I thought it would be amazing to have a competing rails to the traditional financial rails, which many of us were dissatisfied with after the global financial crisis in 2008. And I thought that competition is important, the same way we have competition in other fields. And so I started by buying Bitcoins. Then we opened the Israeli Bitcoin Association that year and the Israeli Bitcoin Embassy. And as the price of Bitcoin rose, I decided to take some of that money and invest it back into companies in the space to allow people, individuals, to make it easier for them to participate in this new financial rails and to make it an alternative to what we had back then with central banks. And the mission is far from over. In 2017, 2018, there was a big hype. A lot of good things happened, but also some bad things, scams, and all this short-term opportunistic plays around ICOs. And basically moving a hot potato from one gambler to another. And I really didn't like what I saw back then, so I thought about opening a fund, and I partnered with Adam Benayoun, who back then was at 500 Startups. He was their Israeli partner. And together we opened Collider Ventures, and now we invest in early stage startups in the blockchain space. We also recently opened Collider Labs, which is our way to double down and work hands-on with companies that are very early and just starting off. And yeah, happy to be here and to join this discussion.
Thank you, Ofer. Looking forward to hearing your thoughts. Michael, please.
Thanks. Thanks, Odelia. Thanks for having me on this panel. So my name is Michael Shalov. I'm the CEO and co-founder of Fireblocks. What we do in Fireblocks is we provide basically a market infrastructure for financial institutions that are working with cryptocurrencies and digital assets. We're currently serving, actually, we started about 2.5 years ago, the company in July 2018, and we had a very rapid growth, even like, through the difficult times of the crypto winter, as we call it, 2019. So we now have over 150 financial institutions that are using us. Most of them are actually what we call crypto native, which are basically all the fintech companies that started to work in the space. We have really like, some of the biggest players over there, like for the people that are familiar with, like, Genesis and Galaxy, folks like Celsius, which is like, another big Israeli company, BlockFi, and a couple others. We also have a lot of fintech companies or neobanks that are using us, like Revolut, for the folks that are familiar, that are using us for their infrastructure. And clearly, as more and more of those guys are coming in, we are currently working with them as well. And I think like, the most exciting part is that we're currently working also with some of the biggest banks in the world. So really like, the top custodians and the top traditional banks, is that we moved towards 2021 on the back of the surge in Bitcoin. I think like, just generally speaking, the acceptance of Bitcoin in across the entire traditional financial ecosystem, and the new assets, as we're going to talk about in this panel, around the stablecoins and CBDC. We see a lot of tractions over there, and we're working with those guys. Maybe just to take it a bit back, what we provide them is a highly secure storage, or basically wallet infrastructure, and secure rails for doing the transactions. As of just personally myself, I actually come from a cybersecurity background. So I've been in the cybersecurity space for about the last 2 decades. Started my previous company, which is called Lacun, was acquired by Checkpoint. For who of you are familiar with the Israeli ecosystem, Checkpoint is I think the biggest Israeli public company, and one of the biggest cybersecurity vendor in the world. Was managing their mobile and cloud portfolio before starting Fireblocks.
Thank you very much, Michael. Hernan, please.
Hi guys, it's an honor to be with all of you. Odelia, thanks for the invite. So I'm Hernan. I'm the founder of EOS Israel, which is a EOS dedicated community in Israel. I am also an entrepreneur and engineer. Currently, I'm directing the mobile development at Voice, which is a social network built on the EOS blockchain. Well, it's built on the EOS.io blockchain. There are some elements that will eventually be built on the EOS mainnet. So before I get too technical, I think to your point, Odelia, the current rise of cryptocurrencies is what excites me the most is that back in 2017 and 18, as Ofer was mentioning, the bubble was mainly driven by us and retail investors buying into, white papers, promises of what blockchain can do. And, while the dreams about how blockchain is going to change the world, today, the conversation has switched towards more daily active users, total locked value, transaction cost and speed, actual parameters that are demonstrating real world adoption for the products that once then, became overvalued very fast and are just now starting to see results. So it's a super exciting time, and it couldn't be more bullish.
I agree. Thank you very much for all of you. Truly a group of rock stars, and I'm sure it's going to be an absolutely fascinating discussion today. So overall, it seems like 2020 has basically brought the focus back to currencies, to cryptocurrencies. And if post the 2017 hype bubble, it seems as almost unlegitimate to develop all kind of crypto-based application, and the focus was entirely around distributed ledger and more infrastructure-based application, it seems that 2020 has shifted the focus back to the currency. Now, from a financial institution point of view, we've seen great development with traditional players like PayPal, for example, declaring to be accepting cryptos We've seen players like Visa that have basically declared their collaboration with the USDC Ethereum-based platform, and we're seeing more and more of this. And maybe, Tomer, maybe this question will be more relevant for you as you are working so substantially with financial institutions. Are we expecting to see more traditional payment players that are opening up to crypto in the coming years?
Yeah, again, I think that, since it's good that I talk first because I'm the least knowledgeable person here, in this dignified forum. But, yeah, definitely think that the most interesting trend that we've seen, in 2020 is really, cryptocurrencies, becoming more and more palatable for the traditional financial institutions. You see more and more payment processors, custodians, financial institutions, enabling, the investing and the holding of different cryptocurrencies. So yeah, I think that trend will definitely continue just because there's, popular demand, and that is coupled with slow but steady progress, from the side of the regulators, who are always late to the party, basically providing some tools and guidance for financial institutions to manage the inherent risk that is involved with all these kind of interactions with cryptocurrencies. So definitely, progress, not there yet, will take a long time. But definitely the trend is to continue to see more and more financial institutions playing more and more prominent roles in interacting with cryptocurrencies, at least as a store of value.
Thank you, Tomer. Michael, maybe your reviews based on your experience?
Yeah, so I think Tomer really nailed basically hit the nail on the head. The regulation is probably one of the biggest drivers right now in terms of what we see across the globe. So, yeah, we really have like a customer base that spans from Japan right now to San Francisco. And really what you see is that the traditional financial institutions that are coming in, they're popping out like, from regulatory jurisdictions where there is clarity, right? So earlier this year, there was a very good guidance from the regulator in Germany, BaFin, that basically explained how you should mandate or how you should basically roll out those initiatives. Immediately after, you saw 40 banks out of Germany basically applying for the BaFin cryptocurrency license, and now we're actually seeing in the last month or two, we're seeing basically one RFP per week of a bank over there that is basically trying to set up a digital custody, a digital trading. They want to try to move really fast. Same thing is happening in Singapore, where they basically initiated the Singaporean payment license, which also covers the digital currencies. And probably like, the most impactful thing was basically the OCC guidance in the United States that basically told two things. One is that state chartered banks are able to basically custody digital assets. Basically, the OCC said, well, those are just like, regular assets like everything else. And given the fact that you were custodizing those assets forever, you can basically go and do it. And they also provided guidance around stablecoins. So that guidance is more aligned, I guess, like, with stablecoins like Libra or Diem right now. But once the OCC guidance came out, we started to see really a huge shift and a movement from US-based financial institutions that, at the end of the day, it is the biggest financial system in the world right now.
Mm-hmm. Thank you. So you're basically taking the discussion towards digital assets and regulation, which is another very substantial pillar. Now, these days, despite the proliferation of digital assets, regulators globally, as well as in Israel, are still debating on how to classify those digital assets. And despite the fact that they basically bring, the next generation of capital markets with the ability to index and to, as a next stage, also liquidize basically any assets, right? So from real estate to data, oil, gold, art, anything can now be indexed and digitized, yet regulators are still uncertain on how to classify that. What are your thoughts here? I mean, how should regulator tackle these new assets?
So I guess, like, there are assets that is quite clear, right? Basically tokenized assets that are securities. Usually it makes sense that they will be classified as securities, and that all the security roles that, to a certain extent, but I think that there are certain built-in mechanisms that makes digital securities somewhat simpler from every, I guess, like, end user standpoint than traditional securities. But those things are reasonably clear. What is not clear is really, like, the native cryptocurrencies, what exactly it is. Again, the biggest mess, by the way, around that is again, in the United States, where there are so many different regulators that each one of them decides whether they want to regulate cryptocurrencies or not. So, the SEC basically a year ago, I think they gave some level of clarity that they're not seeing Bitcoin and Ethereum particularly as a security, right? And interestingly enough, the Bitcoin and Ethereum are viewed as commodity, right? So they're basically governed by the CFTC. I heard a really funny story. I don't know, like, at least, like, it's funny for Israelis that there was a hearing in the Senate around Bitcoin about like a week or two ago, and that hearing was in the Agriculture Committee.
That bad, you mean?
Yeah.
They've thrown it to the other side of the table.
No, because, like, it's a commodity, right? So basically,
Yeah.
if it's a commodity, it's like an agriculture thing.
Yeah.
No, I'd like
All
to
right.
agree with Mikhail, Odelia, because I really don't think that legislation or regulation is driving the current wave of adoption. I think regulators and the SEC and the sorts are, innovation is what's driving the adoption, and legislators are catching up, trying to handle the blows that come, so as, for on one hand, not to stifle innovation, but on the other hand, trying to protect the investors. So that is what we are seeing. And the latest example of this is MicroStrategy, right? Like, they put all their treasury into Bitcoin and announced it publicly. And because they're a public traded company, that their stock went up by like 300%. Those are institutional investors that are itching to get into the space, but do not want to circumvent regulations. So they see a company that has invested heavily in Bitcoin. They say, oh, if I buy this stock, that's kind of an indirect way. So I think the financial sector is aware of this. Their eyes are open. That's their job. So they're pretty aware of what's going on, but they're finding the way of how to integrate their services into this new wave of options. Because nowadays, the same dollars that would be losing value stayed on the bank, you just turn them into a crypto stable coin and put it on any service like Celsius or Crypto.com or BlockFi, and start generating up to 10% interest rate on those same dollars without the volatility of cryptocurrency. So the alternative, as Ofer mentioned at the beginning of his presentation, the alternative is in place. The question is, how do we allow more people to access it?
Yeah, I agree. I think that in general, it's true that the regulators do not initiate or develop innovation, yet their role specifically within the financial service industry is extremely essential to facilitate innovation, to basically protect the end consumer, and to make sure and enable the regulation to become mainstream. But that's another discussion. I want to please move to the next basically subject, and to focus a bit on the Bitcoin itself. So the COVID crisis, at least at its early stages, was basically followed with a huge uncertainty and concern regarding the ability of central bank and all kinds of monetary authority to stabilize and maintain currency values. And at the beginning of the crisis, specifically mid-March, the Bitcoin prices crashed to 4,900, and many basically already declared the death, so to speak, of Bitcoin, and saying that this represents an example of how the Bitcoin cannot serve as a store of value and basically as a mean of exchange because of its high volatility. Yet today, 10 months in the COVID crisis, we see Bitcoin prices that are surging. So basically hitting almost the all-time records. And my question to you is, do you believe that basically COVID and the current financial landscape strengthen the Bitcoin status and basically maintain and make it to be regarded finally as a store of value, or are we expecting to see now a huge crash?
I think
Take that if that's okay.
Please go on.
So, well, a few things on that. Well, first of all, I'm wearing the Honey Badger shirt, and I don't know if some of you are aware of the meme that Honey Badger don't care, and so likewise, Bitcoin doesn't care. You know, things happen, and they say it's dead, and yet it's still alive, and you know it keeps on going. There is this website, 99 Bitcoins, that gathers all the Bitcoin obituaries that were written across the, you know, over the years. I think the first one is in 2010, was the first time Bitcoin was declared dead publicly by someone. And the last one was a couple of months ago, it was dead again. And yeah, so Bitcoin is anti-fragile. It keeps strengthening, and it just is. And I also relate to Plan B's theory, if you follow him on Twitter, which is the phase transitions. So he says that like you have ice, water, gas. Bitcoin also changes. At first, you can say it was this thing to tinker with, you know, an experiment when it first started, 2009, 2010. Then somebody exchanged 10,000 Bitcoins for 2 pizzas. It started having some value, and people started speculating on it. Later, like larger investors came in, and it became this thing to diversify. It was uncorrelated to markets, and other investors started to invest in it. And now, as Hernan mentioned, we see MicroStrategies and some other companies taking it into their balance sheets to protect their values. And you know, I think the fall to, what was it, 4,000 more or less in March. I think it was, you know, like all other assets, people went to the dollar because that's what most things are denominated in. It happened to gold, and it happened in the stock market, and yeah, now things are back, right? Dollars are being printed, everyone's happy, stock market is up. Now, whether Bitcoin will fall in value or not, you know, that's a crystal ball question, which I can't answer. But from my experience, Bitcoin always surprises me. So I'm optimistic for the long term, and I would know for the short term. I say, if you want to invest, then dollar cost average. But yeah,
I wanna offer, you know, contrarian view here. I think that, you know, still, you know, if anything from what happened in the past 8 months, it actually proves that Bitcoin is still extremely volatile, you know, and you know, I think there's definitely a completely straight, you know, sort of like one correlation of one between consumers' interest in, you know, an asset and its volatility. So yeah, naturally now Bitcoin is very volatile, more than it was maybe 6 or 8 months ago. So yeah, naturally now it's cool again to trade Bitcoin and to hold Bitcoin. And you see, you know, by the way, I don't think that it's a coincidence that Revolut is all of a sudden profitable again. It's just, you know, from crypto trading, right? So I think it will, you know, definitely continue to stay volatile, at least for the short term. You know, I agree, long term, I completely agree with Ofer. You know, we have to agree on something, right? So it's still, the jury is still out, but given its popularity and the fact that, you know, retail, you know, still most of the trading, you know, and most of the value in crypto world is still in Bitcoin, it will continue going in that direction.
So to all our viewers that are taking notes and wants to know whether to buy Bitcoin or not to buy Bitcoin, what should we tell them?
Buy 10 years ago. That's the best time.
Yeah, of course, clearly.
Buy a time machine with your Bitcoin. Yeah.
Plan B stock to flow model, which offered Benson Plan B. According to his model, the volatility that Tomer mentioned is actually going down as Bitcoin prices increases in an order of magnitude, right? So, for example, from top to top, from the last bull market to the last bubble, which was $1,000 to a 20,000, so that's a 20x increase, right? So that was almost half of the increase from the first bubble, from I think $37 or something. And then what we should expect is the next top of the next bubble to be around the 10x from the current top. So that is, for example, if you follow the stock to flow model, nobody knows where the top is going to be. But what is most likely to happen is there's going to be another blow off top, another bubble type scenario that will cool off again, and it'll continue like that. And each cycle will be getting smaller and smaller until the Bitcoin actually will be a very, very stable currency. At what value? I don't know.
Thank you, Hernan. So for whoever was able to get a clear answer from Hernan regarding that, thank you very much.
I wonder how this conversation will age, like 20 years from now.
Exactly.
We'll see.
Exactly. We're going to stay tuned. Now, I want to touch on another point. You've mentioned quite briefly the whole discussion around stablecoins and the fact that both traditional financial institutions like JP, for example, with the JP coin, are launching their own currencies. Also, non-financial institutions like the Facebook DM, as well as other decentralized interesting products like the DAI. Are we expecting to see more and more projects like that are arising in the coming years, meaning stable coins that are targeting specific industries, specific customer service line? What are your thoughts on that, Ofer?
Yeah, so I think that as a central bank digital currencies will start, rolling out and being a part of our lives, then there will be less of a need to a lot of those stable coins, which at the end we rely anyway on the stable bank, right? If you have a stable coin dollar, then that's where its value is derived from. But in the short term, then yes, I do see more and more stable coins coming out. And I'll add that there is some advantage or another justification, you could say, for stable coins that are decentralized. So DAI is an example. There are a few other protocols that basically they take some collateral and by a programmatic way they match the value to the US dollar. So and that enables anyone to have his value stored in US dollars, but it's decentralized and permissionless, and you can program it, and you don't need to ask anyone to use it, etc. So that has, I think, some extra use cases, which the governments may or may not like. That's another discussion. But yeah, other than that, I'd say that long term we'll see less stable coins the more that that CBDCs are out there. Yeah, one thing that interests me is if we could find something that is stable enough, but is not connected to a central bank. Something that is everything is online on protocols, similar to how Bitcoin works, but that somehow the protocol itself stabilizes it. I think there are a few ideas. Some of them are working, but yeah, that's something that I see value in.
Mm-hmm.
So maybe to provide some comments on that. So just in terms of the volumes that we are seeing in terms of stable coins, it's just amazing. So to give you some numbers, in November, through the Fireblocks network, we sell $32 billion of digital asset value. Out of that, 30% is stablecoin. Okay, so interestingly enough, by the way, 60% of that is like Tether USDT, which one would argue if it's actually like a stable coin or not. I'll leave it to the audience. But what we're saying is that USDC, which is really a fairly clear and a fairly well-governed stable coin, sort of peaked from like 10% to like 30% of our volume, the stablecoin volume, in since the beginning of the year, right? So basically, we actually seeing like more and more acceptance to that. I think that like most of that is currently being used for settlement, right? But for example, we at Fireblocks, we actually we incentivize our customers to pay us with stablecoin. Okay, so 30% right now, or 40% of our customers, instead of paying us, we accept like we don't accept I guess speculative currency as a payment. We accept like we bill people we bill our customers in US dollars. So 40% of our customers are not using Swift or ACH or Stripe. They're actually paying us with, we accept USDC and PAX. And especially for international payments, it's just amazing. It basically like how superior it is to any other type of payment. Once you basically get into that, you understand how revolutionary it is to bypass all the traditional rails to really accept payment. It's like sells in 15 seconds. You pay like, depending on the day, but you would pay something between 15 cents to $1 on a transfer. You can off-ramp it immediately if you basically connect, if you have account on Coinbase or Circle, and it just so much better than anything else that you can find in the market. And I think that, by the way, currently, most of the stable coins that you have are in USD, like US dollar denominator. I think that we will see more and more of those being issued on other FX. And I think that it's going to, at least for the short period, I don't know, medium period of time, to really transform how FX market operates. I think it has like huge implications for companies like Pioneer and all the remittance players that's going to completely change the way that this works, especially like once the Facebook stablecoin is basically launching beginning of mid next year. One small comment, I think like there is like huge amount of excitement around CBDC, and just being somewhat involved and being close to those discussions. I think we are still 3 years out, right? I mean, most of it is still running on most of those projects, like 99% of those experimental projects are running on the ones that are running on Corda R3, that is basically a private blockchain. It's not a public blockchain as we are familiar. It's all like lab experiments, and I think we're going to see stablecoins thrive until we actually get to this to the CBDC plateau.
Yeah, and that's another question. How much enforcement will the governments bake into the stable coins? Like the more restrictive it'll be, the more justification there will be for other types of stable coins.
Well, I personally differentiate between stablecoin and a central bank digital currency because they behave differently and they tackle a different use case. But Michael, to your comment, I absolutely agree that in the end, stablecoin will be the next generation version of Swift and will offer, still already are actually offering faster settlement and lower fees. And the fact that they are tied to the US dollar basically ensures stability in price, which in turn boosts liquidity. But I want to expand the discussion a bit towards the extended, I would say, digital finance platform. Because in the end, what those platform enables is more than just settlement. It's more than the fact that the stablecoin is tied to the price of the US dollar. They basically enable you to reinvent or revisualize financial services and products like lending, like savings. And Hernan, I know that you and I had some very interesting conversations around that recently. So I would love if you could please walk us through how does the process of investing within those decentralized platforms looks like?
So the main use case for what we call today DeFi, right, or decentralized finance, is both lending, staking, borrowing, and providing liquidity, right? So and that is one of the main functions of the stablecoins, right? To provide that liquidity, they serve a function. Now, I think the best use case that is very exemplified with MakerDAO, with the DAI token, or with USDT, the Equilibrium, and other platforms of the sort, is where you stake your crypto, whether it's Ethereum, EOS, or other coin, and then based on that collateral and its value, you can actually generate that stable coin that is pegged to the dollar, and its value is preserved through different outside world oracles that maintain that price. Then you can do whatever you want with those dollars, including buying more crypto with that, restake it and whatever. So the difference in service, of course, if the value of that crypto goes below the collateral value that you took out, you trigger what you call a margin call or a liquidation event, right? And you have to pay the debt at the value and basically run out of money. Anyway, the important thing here is the difference in user experience between going through this smart contract, depositing your collateral and getting the USDT out, and that's basically it. You're signing a pair of you sign 2 transactions on the blockchain versus going to the bank and saying, hey, listen, I want to take a loan based on this collateral, and then they're going to ask you, what do you want? What do you want this money for? The basic principle of going to the bank asking for permission to use your money for collateral, the whole process is we can already hear how outdated that sounds now that we have this process of lending, right? So I think that's a basic use case for DeFi. Besides all other use cases like trading automatically with an automatic market maker like Uniswap, which is what Bancor back then already started, but it wasn't called DeFi back then because it was not a buzzword. So it is a buzzword today, but that's basically what it's at, right? An algorithm that determines the price of an asset in terms of supply and demand automatically without the need of a seller or a buyer in each side of the transaction.
Yeah, and maybe I just to talk about some of the things that are more high level and structure around DeFi, right? Which I find fascinating, is actually how it changes all the perception around counterparty risk, right? So if I go to the bank and I basically tell them I have $1,000, take those $1,000 and give me an interest, I don't know, negative interest, I guess right now, but let's say they will give you 1% interest, right? Essentially, what they're doing on the back end is that someone is borrowing it, right? And I'm taking full counterparty risk to that bank that hopefully they're managing that loan properly. And I don't know, in most jurisdictions you have like the concept of CDIC insurance, right? That basically the central government will insure those deposits until a certain amount, right? So there's sort of this pyramid of counterparty risks that you're taking until at the end you really trust the government that if something bad will happen, they will be there to protect you, again, up until a certain amount. In DeFi, it's like magic, right? You basically don't have any counterparty risk to anyone. When you use, for example, Compound, which I think it's probably the biggest DeFi protocol right now after DAI. I'm not sure exactly, but let's one of the biggest ones. The algorithm sort of promises you that there is an over-collateralization on the other side, and it works so fast that basically if the market moves, then at least as a lender, you're actually protected. So about 2 weeks ago, there was an incident over there that basically the DAI price fluctuated and actually moved against the stablecoin, against USDC. And the guys that were basically borrowing, some of them were liquidated, but you could have seen how sort of protected the lenders were in that particular situation, how smoothly it basically operated. And I think that one of the key promises of that is really to disintermediate all the centralized players that we currently trust them. And trust has costs, right? When you basically working with someone that you trust, you're essentially paying them for that trust.
Yeah, I'm glad that you brought this up, because I think that what we're seeing here is basically a lot of the DeFi ecosystem sort of going through the same process that the financial ecosystem went through for the past 2,000 years, learning much faster, of course, based on technology that solves many of the problems, but still, I believe that the current ecosystem is still built on, principles And I believe that, if I'm eventually, a forward-looking statement, I think that we'll see, more and more sort of like the DeFi ecosystem takes, mimicking at least the basic principles of the financial ecosystem. Again, like, the notion of trust, the notion of, liquidity management, again, margin call, where did margin call come from, right? It's from, so basically, the concept of, like leverage, like risk management and things like that. So at least what I see is definitely, I think that a lot of people finding it hard to grasp that, some of these notions, because they are, if you're used to thinking of, in terms of the traditional financial ecosystem, it sounds to you as Michael said, like magic. But I do think that, we shouldn't, we shouldn't kid ourselves, and we shouldn't and I think that the challenge is that many of the players in this ecosystem actually forget that, forget these very basic principles of, eventually, like circuit breakers, for instance, look at, all the algo trading, system, and what they cause to, to the trading world, right? Because most of the stocks today and equities are actually traded by machines today. The derivatives and volatility of the market is actually becoming much quicker, and you need circuit breakers. These circuit breakers are still, nascent in many of the DeFi applications. So again, this is sort of like, I think, what we should see in the coming years of DeFi evolution.
Yeah.
Thank you. Thank you,
just
Tamar.
to comment on that.
Go on.
I think there's still a lot of technical risk over there, but I'm not sure that eventually it will end up with circuit breakers. I think that we just solve the technical risks, and it will end up in a slightly different way than the traditional ecosystem.
I think that in the end, the whole issue of risk has a few pillars within it, right? So first, like you said, Michael, is around the technical risk, but B, there's also the risk with regards to the societal function, so to speak, that is now being replaced by algorithms, and can true consumers, which are not early adopters of, Bitcoin and decentralized assets, should choose to adopt it. And C, from a more, financial operational point of view, who takes the responsibility? Who holds the liability? Who actually insures those platforms, right? Because in the end, we do need someone to take the responsibility for it, whether we're speaking about a decentralized exchange or whether we're speaking about even all kinds of the different kind of blockchain-based platform that still requires certain kind of a trusted entity to basically be the responsible adult in the room. And that, unfortunately, still, I wouldn't say hasn't been solved, but still pose a challenge to many of the scale applications that basically tackles, I would say, long-term use cases, which includes the collaboration of several partners and not just internally within one value chain within the enterprise and the organization. But absolutely a lot more needs to be taken here. Now, another final, not final, but maybe one of our last points I want to touch upon is the emergence of new protocols, right? So given the rise in number of crypto and blockchain-based transactions and the need for greater scalability, we're seeing the development of more and more new protocols that are using all kinds of other proof of work, proof of stake to basically validate the transaction. And I'm keen to learn from you, what are the main advantages you see those new protocols offering to the market? Maybe Hernan, as a representative of EOS, you'll take the lead on that.
Well, originally the consensus protocol, which is what allows for the blockchain to have this single source of truth that actually validates all the transactions that have been made and has a permanent record of it, a public one, that has evolved as blockchain has evolved, right? So the Bitcoin, the consensus algorithm as proof of work, which has an inherent cryptographic proof that the machines have broken the algorithm this time to figure out the next cryptographic block in order to ensure that the block is secure. So that is super secure, has been proven, and super slow and super energy inefficient, right? You cannot run real world applications on Bitcoin currently on a first layer. There are other solutions, but let's say on a Bitcoin blockchain per se. Now Ethereum came along and it did offer an upgrade, but that upgrade is not an order of magnitude. If Bitcoin can perform around 7 to 9 transactions per second, Ethereum nowadays, not speaking about Ethereum 2, which may solve this, but Ethereum nowadays processes around 20, 21 transactions per second. So that still cannot serve a global audience and real world applications. Now, if you take consensus algorithms like EOS, which is delegated proof of stake, which is what most of the third generation blockchains, as we call them, are using, or a variation of delegated proof of stake, is when you actually use your tokens to vote or assign them to node validators that they have the correct equipment to process the transactions, and then that way the blockchain is still decentralized, but it is much more efficient. So EOS is currently running on a 4,000 to 5,000 transactions per second. The testnets have performed much faster, and there's always a balance between how many nodes validators are required to validate that a transaction is actually verified, and how fast is the network, right? So I think that's coming into play nowadays, because it is very palpable when you're using a real world application. You would not wait for a confirmation to just press the like button on a blockchain social network so that you can then confirm and wait for a few minutes until your light turns blue, right? It's not going to work nowadays. So if you want to build real world applications, you need to scale the TPS, the transactions per second that the blockchain can perform at. So that is the basic thing. Then we come into both transaction cost and also usability of the blockchain, because if you go about handling private keys and public keys, then not every user is user savvy, right? So EOS introduces, for example, the concept of user accounts, which are generated through an EOS wallet, and that account has 12 Latin characters. There's EOS Israel EOS, the wallet of EOS Israel, and I know it by heart because it's not that tough. It's 12 characters. Now that is an address that I can handle myself in the world without the risk of copy pasting my address and being prone to that copy paste hack that we all heard about. So those are some stuff. There's a whole concept around how do we build a blockchain that is actually usable for the day-to-day person without him being tech savvy and as easy as we use today Gmail or Facebook or Instagram, right?
Fascinating, thank you. Go on.
Yeah, I'd like to add to that. Well, a few points. So in terms of energy consumption, then it's all relative, I'd say. I'd argue that the financial system today is consuming a lot more energy and waste than Bitcoin is. Sorry?
It's also handling quite a lot of more trillions of dollars.
Right, which brings me to my next point. The narrative between Bitcoin and Ethereum and probably a lot of other coins is very different. Bitcoin is supposed to be slow and reliable. Decisions are being made after, it can be 2 years of deliberation, and there is the BEEPs, the Bitcoin improvement proposals. So those take a lot of time and consideration from developers in the community. It's very decentralized and open, and they don't, it's not something that they do very often, a fork in the Bitcoin network or an upgrade or soft or hard fork. So Bitcoin is supposed to be this thing that you can rely on to work. While Ethereum is still in its startup phase. They don't know exactly how many coins are there and how many coins there will be. It's just different. I like both. I think that Bitcoin would be a better store of value. Ethereum would be easier to build new things and to test them out and to break things. And there are a lot of solutions. I mean, some of the solutions can be to move to different chains if you want to interact, like they have wrapped BTC on Ethereum, etc. Other solutions would be to use just centralized exchanges. Those are super fast, or Lightning networks, layer 2 solutions. Or, well, Lightning is just one example, right? And some improvements in UI even, there are companies that just make it easier to hold these crypto assets. We've invested in Zengo, of course, Fireblocks, another one. Thank you. So yeah, there are improvements, and I'm all for competition, and it's great to see this innovation, and that's what's wonderful about our space, that it allows for true innovation. There are no hurdles. As opposed to getting a license and all that. I mean, once you touch regulation, it becomes very, very slow. And Tomer, you can probably say it much better than me. A fintech veteran. I'm new to the space relative to Viola. I think I would assume it's very hard to build a fintech startup, and they're in the traditional world, and there's only so much you can innovate. Especially in Israel, it's a catastrophe. They didn't do anything, the APIs for banks, all that. No, the regulators,
Yeah. But I think, I just want to, I know that's a little bit going back to our previous discussion about, central bank coins, but, if anything I'm more excited about is actually, the reason why, we are sort of a little bit stuck. We feel a little bit stuck is the fact that as we said, regulators move so slow, but on the other hand, they're the basically which we trust. Eventually we trust them. I'm not talking about the people who don't trust the government at all, but and so actually what I would be really excited to see is actually one of the FAGMAs. Take let's look at Google, for instance, right? Basically today you can live in Google country, right? You can live in Google campus, probably get, education, health services, anything. At some point they'll start providing monetary services, right? And it will be...
Do you know Iri Yamin in Netanya? It's the same concept,
Yeah, but unfortunately it's not from being run by Google. But,
not the same facilities.
So this is one of the things I'm most excited about, because at some point it's bound to happen, and then really, that would really create sort of like a completely sort of like new, digital jurisdiction, driven by sort of like Google or Facebook or whatever coin, there's a certain extent, they're going to stop playing nicely with regulators.
Yeah. Thank you, Tomer. You're basically bringing us to the next point I wanted to discuss, which is the CBDC. So indeed, central bank digital currency raises a lot of challenges and concerns like the one you just mentioned, sovereignty, monetary control, how do you actually monetize it? There are also different kinds of types and models of operations of a central bank, right? A wholesale, a retail one. We know that Sweden just 2 days ago have declared to be launching their own e-Kornia to testing in the following weeks. My question to you guys is, we know that more than 80% of central banks globally have declared to be experimenting with the CBDC. But my question is, what will happen when you have a huge player, for example, like China, which launches a central bank digital currency, and clearly the influence will be much more than just, the circulation of currencies in the M0 within China, right? The consequences might be much more encompassing and overreaching. How do you think that a launch like that might influence global economy, financial market, and the development of other stable coins, or like you said, different, Amazon coins, Facebook coins, and others?
So I think I'm going to take it first. I think the best model that we can think of was explained by Andreas Antonopoulos in one of his presentations. He mentions a new evolution, and instead of having this one single type of money, which we've had, which is government-generated money by the central banks and whatever, we're going to have 3 types of money, which is the governance money, which we know already, the corporations money, or the companies' money, like Facebook's Libra and Google Coin, and those big corporations that have a lot of influence. We see it with WeChat and their currency, and the people's money, which in this case would be Bitcoin and other decentralized cryptocurrencies, right? And they are going to now start to compete on the same turf, because for the one hand, they're all, most of the fiat currencies are already digital. So let's face that fact. What they haven't been, and what would change with the CBDC, is that they would most likely be working on a publicly verifiable blockchain, which in turn would give it access or liquidity to people's money or cryptocurrencies, right? So then I think we will have a new scenario of kind of this supply and demand with these different currencies, and people are going to flock, differently regarding on where do you live. Like if you, for example, live in China, you cannot handle yourself with crypto or corporate money. You will need the government's money in order to live your daily life. Maybe in Israel will be different. We don't know.
So to your perception, we're going to move towards community-based currencies, so to speak, or different services-based currencies?
I think the three will always compete, but they all have different incentives. Unfortunately, the incentive that the government money has is mainly, like the military and violence and laws and putting you in jail if you don't comply. And maybe people will flock into a different type of currencies which have different types of governance models. I guess time will tell.
Mm-hmm.
Death and taxes. I think that, what we're, I think the only caveat to what Hernan said is that, what's really interests the government is taxes. As long as, there is a mechanism that, enables the government, the sovereign, to collect tax, and ensure that people are not being defrauded. I think that there's a good chance that, we will sort of gravitate to such sort of like a multi, medium of exchanges, medium of value ecosystems.
Well,
thank you.
There's also a question of, if tomorrow morning we had USDC, right, would have been minted by the Federal Reserve, right? Why would people actually would use something that is not USDC, right? I don't know, what's the answer to that question, but I think that the view, at least around the Chinese central bank digital currency, is that there is a much wider agenda over there, right? In terms of what they're planning to do and how they're going to essentially try, or at least try to enforce a fairly different monetary global, at least maybe even regional monetary system, which expands beyond the Chinese borders.
And there clearly is quite a wider agenda over there, as we all know.
Yeah. If I may, one phenomenon that kind of goes well with what we just heard from all of you is free private cities. It's we have all these currencies competing with each other, and competing with the countries as well. And free private cities is this new phenomenon of competing on the market of living together. Currently, there's mainly Honduras that passed laws that allow a great autonomy for entrepreneurs to create their own cities, introduce their own laws, and monetize them. So it's like startups. You want to create the best product for your clients. Your clients are people that are living in the cities and opening companies, and the best laws. They could or they would or would not create their own city currencies. I assume that it's at the beginning they won't. But yeah, I think we'll see a lot of competition. We already are starting to see, or can imagine seeing, in terms of currencies, but I think also with countries themselves, and how we organize ourselves with politics and laws, and exciting times.
Absolutely.
The biggest risk I see with the CBDC creation and their proliferation, especially by being as wider reach as China, is when you move into a cashless society, right? and you can have a centralized control of the main source of how people do their living, which is money, right? Then you can actually first, it can be for good, right? You can implement a system of UBI or basic income where nobody goes out hungry, right? But that can also be conditioned to if that person complies, right? So if you comply, you'll have your daily share, you'll have your money, you can do whatever. The minute that you're a bit of a dissident or you're not agreeing with what your government is liking, you can be turned off just like with a switch. And
1984 wasn't supposed to be a manual.
Yeah.
What are you going to do? How are you going to buy food with? So that's a huge risk that we are not openly discussing with the CBDC, but it's a very real possibility, right? Either comply or basically die or get excluded from society.
Or just you're just old, and just don't know how to use technology.
Absolutely.
So that.
Yeah.
So guys, with that note, I think unfortunately we need to finish because our time is up. This has been extremely fascinating, and I'd like to personally thank each one of you for participating. For sure, 2021 is going to be fascinating on the sense of CBDC, DAI projects, DM projects, and many other crypto-based developments that are coming. We're all, I think, very much looking forward to see what will happen, and also looking forward to see the end of the COVID crisis and everything that's come with it. So stay safe, have a great year, everyone, and looking forward to see you in person very shortly. Thank you.
Thank you.
Thank you, guys.
Thanks, everyone.
Thank you very much.
Thanks, everyone. Bye-bye.
Bye.